Good day, students. You are welcome to another episode of Financial Accounting. In our class today, we'll be taking a topic called joint venture accounts. But before we go there, in our last classes, we've talked about trial balance, the errors that do affect trial balance, and the errors that cannot affect trial balance. I believe you can still remember all the errors that do affect the trial balance and the errors that are not going to affect a trial balance. We discussed about error of omission, error of commission, error of original entry, error of principal, and the rest. I believe we can differentiate between all these errors, and you know all the errors that are not going to affect your trial balance. Today, in today's class, we are going to talk about joint venture accounts. What do we mean by joint venture accounts? From the name, from the topic, you can see, you can even bring out the explanation or the definition of joint venture account. Let me make it simpler. Let me make it easier for you. What do we mean by joint venture accounts? Joint venture account is when two or more people comes together with a motive of trading, with a motive of carrying out a business. For what? For profit making. Most of our businesses are there to make profit. We don't just go into business for going sake, but we go into business for profit making. Now, when we are talking about joint venture accounts, this joint venture account is talking about when Mr. A and Mr. B is coming together. Okay, we are going to buy a shares, we are going to sell it together. This is how we are going to do it. They make plans on how they are going to do it. That is what we mean by joint venture account in a literal meaning. People coming together to trade, to carry out business with a motive of making profit. That is joint venture account, as simple as it is. Now, let's look at it together. Joint venture account. Joint venture account is simply a venture undertaken by two or more persons with a view of making profit. You can see from what I said the other time, view of making profit. Two or more people coming together to trade. Two or more people coming together to carry out business transaction. For what? To make profit. This is different from your partnership account because it is of a temporary character. I believe you all understood partnership account very well. What do we mean by partnership accounts? Now, we are not going into partnership account today, but we are going to make a distinction between partnership account and our joint venture account because it looks similar, but they are not similar. Why are they not similar? Joint venture account is just there for a temporary moment, or for a temporary, I said for a temporary character. It is of a temporary character. Maybe they just, the business, the venturer, they just see an opportunity to make business, to make profit, to make money. They come together for that motive, not for a continuous, not for a long period relationship, or not for a long period transaction, but for to achieve that particular purpose for that particular period. This is the reason why your joint venture account is quite different from your partnership account. Partnership account is for a long period of time, but joint venture account is for a temporary moment or for a limited time. Please take note of this. This is one of the greatest characteristics, or one of the characteristics of joint venture accounts. Characteristics of joint venture accounts. What are the characteristics? What makes up a joint venture account? What are we going to see in joint venture accounts? In joint venture account, the profit sharing ratio must be clearly defined, either equally or agreed by the venturers. The venturer are coming together, maybe 2 people or 3 people. Now, they should differentiate, or they should spell out how their profit is going to be shared. Is it 20, 40, 40? Is it 50, 50? This must be well spelled out at the beginning of the venture, because they are going in for profit, and the profit, there should not be disagreement or misunderstanding at the end of the venture. So the profit sharing ratio must be clearly defined even before the venture is embarked upon. The second point we need to consider is that the capital, the activities, and the scope of the venturer must be laid down. This is how we are going to do it. This is what Mr. A must do. This is what Mr. B must do. Mr. A has a distinct assignment. Mr. B has a distinct assignment. The capital, the activities, and the scope of the venturer must be laid down. Individual venturer knows what is going into the venture to do. This is another characteristic of a joint venture account. Now, the procedure. What are we doing? How are we doing it? Each venturer, for example, Mr. A, we are assuming two people in a venture now, Mr. A and Mr. B. Mr. A and Mr. B, two people. Now, each venturer opens an account to record all matters which concerns the particular venture. This is called a joint venture with A, or for what we have here, the joint venture with XYZ, the name of the other party to the venture. Like I said, we have two people, we have two parties, Mr. A and B, and this will be joint venture with Mr. A. That is, in the book of Mr. B, we are going to have joint venture with Mr. A. And in the book of Mr. A, we are going to have a joint venture with Mr. B. It means Mr. A is opening his account, is opening his book, showing his joint venture with Mr. B, while Mr. B is opening his account, showing his joint venture with Mr. A. So, the venturers, two of them are preparing individual account. That's what we mean by the joint venture with Mr. A or joint venture with Mr. B, whatever name we have in the name of the venturers. Now we need to take note of some things here. If cash is paid out, you debit your joint venture account and you credit cash account. Cash is being paid out, maybe for purchases, expenses, carriage, and the rest. In this case, you are going to debit your joint venture account because joint venture account is actually making the expenses, and you are going to credit the cash account. Then if you have a cash, if cash is received from sales, I said it at the beginning that we are going into the venture to make sales, to sell things, to make profit. Now, if cash is received from sales or even from the other party, maybe Mr. A is contributing a particular amount to the venture, you credit your joint venture account and you debit your cash account. For any charges agreed upon, e.g. commission, the venturers are going in to make expenses. There is no sales without an expenses. At least you carry your goods in, you carry your goods out, you make advertisements, you give rent, you give the rest. These are expenses that will definitely be carried out in the course of the venture. Now, for any charges agreed upon, e.g. commission, advertisement, sales, rent, and the rest, you debit your joint venture account and you credit the account of the person who is to receive the commission. Whoever the commission is going into, you debit the account of such a person. At the end of our accounts, like I said the other time, every business is being embarked upon to make a profit, but we have two sides to the account. It can either be a profit or a loss. It's not every day that it will be profit. Let's assume you're having a profit here now. If you have a profit on your venture, the debit side of your joint venture account will be taken note of. That is, we are going to debit our joint venture account and we are going to credit our profit and loss account. That is, they are making profit. Joint venture account will be debited and the profit and loss account will be credited. And if it is a loss, the debit side of the profit and loss account will be taking note of. That is, we are debiting our profit and loss account with the amount, the figure for the loss, and we are crediting our joint venture account with the figure of the loss. After doing all this, when all these entries have been made, the balance remaining on the various joint ventures shows the indebtedness of one venture to another. What are we saying here? Mr. A has prepared his account, Mr. joint venture of A with B, B's joint venture with A. Now, Mr. A has prepared his account, everything intact. He has imputed all the transaction into the account. Now, at the end of it, he discovered that there is a balance remaining. It means Mr. A is indebted to Mr. B, that figure that is remaining is meant for Mr. B. So whatever balance you're having at the end of your joint venture shows your indebtedness to other party. Maybe you mistakenly, or not really mistake, there's no mistake in the account, maybe you buy something that you're unable to pay at the appropriate time, or at the time that this account is being prepared. It shows your indebtedness to the other party, the venturer. At the close of the venture or end of the year, let's get this place clear. Every account is prepared at the end of the accounting year. It can be either the end of the year or the end of the period. Maybe, like I said at the beginning, that this venturer's account is for a temporary period. It's for a specific period. It's not for a long time. Maybe during the course of the business, at the middle of the month, maybe May, the business has to come to an end. It means you are going to prepare an account. What I'm saying here is that at the close of the venture or end of the year, whichever is earlier, it can be the end of the year or the close of the venture, this joint venture account is combined together. That is Mr. A's account and Mr. B's account. We're going to bring these two together to form what we call our memorandum joint account. Sorry, our memorandum joint venture account. What are we saying here? Mr. B has prepared his account, Mr. A has prepared his account. At the end of the accounting year, at the end of the venture, we want to know the profit, we want to know the loss. We are going to combine these two accounts together, Mr. A and Mr. B's account. We are going to bring it together, and bringing it together will form what we call our memorandum joint venture account. And what is memorandum joint venture account is doing for us? This memorandum joint venture account is going to help us to ascertain if they've actually made a profit or a loss, because in Mr. A's account you can't identify if there is a profit or a loss, and in Mr. B's account you can't identify if there is a profit or a loss. But now let's look at it together. After bringing the two together, we are going to analyze all the sales meant for Mr. A and Mr. B, all the commissions they received, all the discounts they received. We are going to bring everything together to mix what comes into them, and at the other side of it, we are going to have all the expenses that they all carried out. That is Mr. A and Mr. B. We are going to merge it together, and looking at the difference of the two accounts now, the debit side and the credit side, this will give us either a profit or a loss at the end of the day. That is what our memorandum joint account is used for. It helps us to know, it helps us to ascertain our profit or loss at the end of the accounting period or at the end of the joint venture. This is what I've said. The memorandum joint venture account helps in ascertaining the profit or loss on the venture. It is under this memorandum account that the venturer, the two of them or the three of them, whatever we have, that is when they are going to ascertain if they're making a profit or a loss. And under this memorandum account, their profits will be shared based on the agreed proportion. I believe you all understand everything we've been talking about in joint venture accounts. I believe by now you should be able to explain joint venture accounts as it is. Joint venture accounts, people coming together, two or more people coming together to carry out the business in order to make profits. I believe you remember that. Then, what are the characteristics of joint venture? It is not for a long period. It is for a specific period of time, not for a long period. And another thing I want you to note is that joint venture account is different from partnership accounts. Though they may look similar, but they are two different things. They are different from each other. And also, in your joint venture account, the agreed proportion on which the profit or loss will be shared must be well spelled out at the beginning of the account. Then, your memorandum joint venture account is going to show you either the venturer are making a profit or they are making a loss. That is what the whole essence of your joint venture account. It is the last account that will be prepared after Mr. A has prepared this account, Mr. B has prepared this account. We are going to join the two together, bring the two together to make our memorandum joint account. And that memorandum joint account is going to show us either they've made a profit or they've made a loss. I believe all these are well understood. And the assessment for today, for the topic we've treated, joint venture accounts, we are going to have this assessment that I will appreciate if you can work on it on your own. The first one is, what is joint venture? What is joint venture account? Then the second one, what makes a difference between joint venture account and a partnership account? You can send your answers to the address on your screen and keep reading. Reading helps you, it makes you who you are. Till we meet in the next episode, have a great time.